Our economy will never be the same, and most people are playing the game of money in today's economy with old rules and then wondering why they're seeing no progress and no wealth. I'll show you. Let's go back in time a little bit. If you go back to the 1970s, back then we had one income households. Generally, the way it worked was the man went to work and the woman in the house did not work. That's just how it was. And back then, with that one income household, one income was able to fund buying a home. One income was able to fund buying a car, maybe even two cars. One income was able to fund an annual vacation, and one income was able to fund college, and people were still able to save money and put money aside for their retirement and investments. Today, we have two income households and people are struggling to buy homes. People are struggling to buy cars. People are struggling to go on a vacation. People are struggling to pay for college, and people are struggling to put money aside for their savings, and people are struggling to put money aside for their investments. Let me show you some statistics. In 1972, the median household income was $11,120. This is from the United States Department of Commerce. Now, if we fast forward about 5 decades later, in 2021, the median household income in the United States was $71,000. This is from the United States Census. That is a 640% increase in household income from 1972 to almost 5 decades later. But don't forget, back in the early 1970s, your household income was primarily just one person's income. Today, our household income numbers are based off of two people's incomes. In 1972, the median home price sold was $30,500. In 2021, it was $346,000. That is an 1,100% increase in home prices. The average new car cost $3,700 in 1972. In 2021, the average new car cost was $47,000. That's a 1,500% increase. 4-year public university tuition went from $500 in 1972 to $9,500 in 2021. That's a 1,900% increase. Now look at these numbers very carefully. Household income grew by 640%, partially because now there are two income earners in one home. At the same time, home prices grew by 1,100%. Car prices grew by 1,500%, and tuition prices grew by 1,900%. This is the new economy, and people wonder now why they're struggling to get ahead. The reason why so many people are struggling to get ahead in today's economy is because the cost of living has grown significantly faster than wages. Now, this is where you have to make a decision, because the decision here is very tough and very crucial at the same time, because most people look at this and they say, this is why we need to complain, cry, scream, be upset. And that's what most people do when they see these numbers. Now, yeah, it is very frustrating when you see this. Don't get me wrong. It is frustrating to see this. But you can still win despite this if you have the right financial education. Now, the reason why this is all happening goes back to the same concept that I've been talking about time and time again. It goes back to inflation. What happened in the early 1970s? In the early 1970s, the United States dollar was taken off of the gold standard. This happened in 1971 when President Richard Nixon severed the dollar's tie with physical gold. Prior to 1971, if the government wanted to spend money it didn't have, it needed more wealth. It needed more gold. But then in 1971, President Nixon took the dollar off of the gold standard, meaning the government and the Federal Reserve Bank could print and spend whatever amount of money they wanted to. So now the Fed can print more money, insert it into our economy, and this then devalued our spending ability. Our consumers got hurt. Our ability to spend gets hurt. Our savings have less buying power. Our wages, our income cannot buy as much. And in turn, the price of things go up. That's what inflation does, because then after 1971, we started to see when we're spending, we started to see more inflation, and that impacts people who are not financially educated. So now, if you're a regular person and you're just trying to get by, you're trying to do all the right things, you go to school, you get a good degree, you get a good job, but now you're working to earn more money, and you're wondering why you don't have the same ability to build wealth like your parents or your grandparents, well, you can thank the Federal Reserve Bank and all the money printing that they did. But now, this is where, again, you can complain, cry, scream, blame the system, blame the government, blame the Fed, blame your boss, blame the bank, blame everybody. but that's not going to improve your financial situation. And so what I'm saying is now, despite all this happening, how can you win in this financial situation? Because the reality is the economy is not going back to where it was. And this is where a lot of people are trying to figure out what's going to happen now going forward. Because now, if in 1970, a one-income household was enough to provide for a whole family, now in 2023, two-income households are what you need in order to provide for a family and barely get by. What does that mean we're going to see in 2030, 2040, 2050, 2070? Now, if you think that 20 years from now, it's going to be like what it was in 1970, where one income is going to be enough, and now with two incomes, you're going to be able to build even more wealth, you're living in la-la land. And this is where I want to bring you back to reality a little bit, because if inflation is what created this big divide between the haves and the have-nots, if inflation is what created the cost of living to rise so significantly, well, you got to understand, is inflation going away? Meaning, are we going to see negative inflation over the next number of decades to bring the prices of things down? That way now you have more ability to build wealth. No, that is not happening. And so if we're not going to be seeing negative inflation, you got to understand what's going on right now. That way you can understand this, number one. Then two, be able to capitalize on this, because the reality is this also creates opportunities for those who are financially educated, and that's what I'm going to be talking about in this video. Inflation is a hidden tax, and it disproportionately hurts the financially uneducated, the poor, and the middle class, and it disproportionately benefits the investors and the financially educated and the wealthy. Now, your question might be why? And the easiest way to understand this is just to see what has happened in the past. If you go back to when the pandemic hit and the government sent out these stimulus checks, what was the purpose of these stimulus checks? They were meant to stimulate. But stimulate what? They weren't meant to stimulate your finances and your wealth. They were meant to stimulate the economy. That's the meaning of a stimulus check. And so now when people get stimulus checks, what did they do with it? Some people saved that money. Some people paid off their debt. Some people invested their money. But most people spent that money. Now, of course, some people needed the money to buy groceries. Some people used that money to go out and shop at Lululemon. Some people use that money to go out and shop at Gucci or Louis Vuitton. But now understand what happens, because now if the government gives $1,000 to everybody, the government doesn't have that money sitting somewhere, right? The government is drowning in debt. The government has a very large national deficit, meaning they're spending more money than they're bringing in. So how does the government just pay out these checks? This money has to come from somewhere. It gets printed. The Federal Reserve Bank has to print this money and they give it to the government. And the most expensive kind of money is free money. So now the government gets all this money, they give it out to people, and now what do people do? They take this money and they go out and spend it. You go out and spend it at Walmart, you go out and spend it at Lululemon, you go out and spend it at Gucci, you go out and spend it at Amazon. This money gets spent. But now, what happens next? The next thing that happens is these corporations have a bigger share of the money. Why? Because when you go and spend this money at Walmart, you spent $1,000 at Walmart, Walmart has more dollars because more dollars are created, more people have the ability to spend, more people go to Walmart, more dollars go to Walmart. Which means now, if there's more dollars in our economic system, the $2,000 that you have in your savings account is a smaller piece of the total monetary supply. You own a smaller share of the total amount of dollars out there. So now, if Walmart is getting more dollars because now people have this money, they're going to go and spend it naturally, Walmart owns a bigger share of the monetary supply, of the money, of the wealth. Now, who owns Walmart? Well, it's the shareholders, the investors. This can be people like you. Anybody can go out and invest in companies like Walmart if you go to the stock market and you buy shares of a company, but it's also the wealthy, the hedge funds, the banks. It's people who understand money. So when I say inflation disproportionately benefits the financially educated and the wealthy, I don't just mean it benefits rich people. It benefits people who understand how money works. Because now if Walmart is getting more money and if Walmart is charging more prices for their eggs and their groceries, well, now if you own a piece of that company, you are benefiting from it, because now when Walmart gets more dollars, you own a piece of that profit. That is the investor side. That's where inflation benefits people. But inflation also hurts consumers. Who is the consumer? Everybody. Rich people, poor people, middle class, everybody is a consumer. Inflation hurts the ability to consume because your dollars, your buying power, your currency goes down in value. That's what inflation does. Inflation hurts the buying power of your money. But The reason why I say inflation now disproportionately hurts the financially uneducated, the middle class, and the poor is because most people are only consumers. Most people don't have investments. Most people don't understand investments. Most people are not financially educated because, well, none of us are taught this in school. The people that are taught this are those people who have rich parents, and then they pass it down to their kids. If you don't have rich parents to tell you this, where are you going to learn? You can read books, or thankfully now, thanks to YouTube, you can watch videos and you have more access to places to learn. But if you don't go out of your way to learn, like most people, you're going to be running in this game without even understanding the rules. And so now, understanding where we are in this economy today, you got to project where are we going in the future. Because let me tell you something, inflation is not going away. The Federal Reserve Bank says that they want to bring inflation down to 2%. That doesn't mean that inflation is going to go negative. It doesn't mean that the prices of things are going to go back down to where they were in 2019. That doesn't mean that we're going to go back to where we were in the 1970s. That means they want to cool down inflation, meaning they want the prices of things to rise, just not as fast as they were before. The Federal Reserve Bank has wanted inflation forever. I mean, inflation has been around for a long time. But the reason they like that 2% target is because that 2% number is just enough that the average person doesn't notice it. And how do I know this? Because back in 2017, 2018, I used to go out, walk around the streets. I went to Chicago, I went to Washington, D.C., I went to New York, I went to San Francisco, I went to L.A., and I talked to people around the country about money. This is before the pandemic, back when inflation was between 2 to 3%. And I asked regular people on the street, what is inflation? And most people, the vast majority of people, had no clue of what inflation was. That is what the goal is of the Federal Reserve Bank, because if people are not worried about inflation, no one's going to question it. And that's what's been happening for decade after decade after decade, that we start to see the slow inflation, which causes the value of your dollar, the value of your earnings to drop, the value of your savings to drop while the prices of things go up. And most people never see it happen. And when you don't see it happen, that's what allows it to continue. And that's why most people just don't understand why they're not able to build wealth like they could before. And so now, what do you do? If this is the situation that we're in right now, what do you actually do to win despite this? Because there are 3 things that you need to do, and this is not going to be rocket science, but there are 3 strategic things that you need to do. Number 1 is you're going to have to strategically spend less money. Number 2, you're going to have to strategically earn more money. And number 3, you're going to have to strategically invest this money. I know, this is not rocket science, but this is something that becomes significantly more crucial, especially in times when you have this type of high inflation, especially when you have this type of economic slowdown that we're seeing, especially when you're seeing these types of higher interest rates, because if you don't understand these 3 things, and they might seem self-explanatory, but if you don't do these 3 things, then you don't have the ability to capitalize on the opportunities that might come your way. Because let me tell you what's going on right now. What we're seeing happen today, we've been seeing the high inflation. And now we're hitting a point where many Americans are saying, okay, you know what? I am definitely seeing the higher costs of things. And it's becoming more and more difficult for me to continue funding my lifestyle, to pay for my higher rent, to pay for my higher expensive groceries, to keep going on these vacations, to keep eating out at these expensive restaurants, to keep living my life. So now I have a choice. Either I can cut back on my spending, or I can just dig into my savings and go into credit card debt. And what we're seeing statistically, this isn't me just spitting out words, statistically, more and more Americans are saying, I don't want to cut back on my lifestyle. I'm used to eating out at these nice restaurants. I'm used to going out on these nice vacations. And so instead of me cutting back on my lifestyle and living a life that I can afford, I am going to now put it on my credit card. That's why we're seeing credit card debt levels rise very quickly and breaking new record highs. And then you're also seeing more and more Americans digging into their savings, pulling cash out of their life savings. That way they can fund not a big purchase, but their regular expenses. We are seeing this happen today because now we're in a time where people are having to make that decision. And the first thing that people decide is, I don't want to cut back. Let me continue funding my lifestyle by using my savings or by using debt to continue funding my lifestyle. And that is a very dangerous decision right now if you want to build wealth, because if you want to be able to have money to capitalize on opportunities, the most accessible thing that you can do, not the easiest, not the funnest, but the most accessible thing that you can do is spend less money, which means you might have to downsize on your car, which means you might have to downsize on your apartment, which means you might have to downsize on your home, which means you might not be able to eat out as much, which means you might not have to go out on as many vacations. And that sucks to make sacrifices, but that's where we also have number 2, which is work to earn more money strategically. Now, these are things that we've been covering very in depth on Market Briefs. If you have not joined Market Briefs yet, this is why I keep recommending it, not just because, well, I think everybody should read it, but because it keeps you up to date with what's going on with things like inflation and the economy, the housing market, the stock market. That way you don't get blindsided by what's going on. Market Briefs is a completely free newsletter where my team is breaking down what's happening in the financial news. You can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. The second thing that you have to do strategically is you have to work to earn more money. And the reason why this is so important is going back to just the trajectory of how our economy has been. The household income from 1970 to now has gone up, not just because people's wages have gone up, but because now there's more incomes in one household. Now, if we fast forward to what it's going to be like 30 or 50 years from now, it is going to go down the same trajectory as long as we continue to see inflation, which means people will need more income in order to be able to survive. How are you going to be able to do that? You are going to have to work to earn more money. Maybe that means you got to get a second job. Maybe that means you got to work to increase how much money you can make at your current job. Maybe that means you got to get a certificate. Or maybe that means you work to start a side hustle or start your own business. The good thing, the beauty about today is that there are more opportunities than ever to earn more money. So if you feel like you are not making enough money to fund your lifestyle and invest and save some money, you are going to have to earn more money. And this is so important because a lot of people are very hesitant to look at reality objectively. Let me tell you what I mean. If you look at something like the housing market right now, home prices have gone up significantly. And at the same time, mortgage rates have also gone up significantly. That's a double whammy for anybody who wants to buy a home. Because now, over the last few years, not only have home prices skyrocketed, so you have to borrow more dollars to buy a home, but the interest rate you have to pay for that mortgage has also more than doubled in just the last couple of years. And so now if you want to buy a home today versus say 2 years ago, it's going to cost you way more money. Now, why are interest rates rising so fast? Well, this is because partially the Federal Reserve Bank, our central bank here in the United States, is raising interest rates aggressively to bring inflation down. Again, they don't want to see deflation. They don't want to see negative inflation. They want to cool inflation down, meaning they want the prices of things to rise at a more moderate pace that doesn't really affect people in a way that's very visible. But that means that there's going to be pain with the higher interest rates. One of that pain is you got to pay more money to borrow money. So now, if you want to go out and buy a home, now you're looking at much higher mortgage rates. Well, if you are a banker, if you are a mortgage lender, that's kind of not so good news, seeing these higher interest rates because, well, supply and demand. People want to buy things more when it's cheaper, right? When mortgage rates are cheaper, naturally you have more demand for a mortgage. More people are going to want to buy a home when you can get that mortgage for 3% than when you have to pay 8% for that same mortgage. And so this is where mortgage bankers are starting to feel a little bit of a pinch because you just have less demand for refinancing. You have less demand for mortgages today because mortgage rates have gone up so much. And so naturally, that's going to create some concern. Well, what's going to happen to the mortgage market? Are interest rates going to keep going up? What's going to happen to my mortgage business? What's going to happen to my mortgage income? As a banker, naturally, you're going to be worried about these things. Well, that's where you then have associations like the Mortgage Bankers Association, which is a big organization that helps tell mortgage bankers what's going on and what to prepare for. And what the Mortgage Bankers Association has said essentially is that don't worry about what's going on in the mortgage market because mortgage rates are going to fall. The Mortgage Bankers Association put out a statement where they said that mortgage rates are going to fall to 5.2% by the end of 2023. And the reasoning why mortgage rates are going to fall to 5.2% for a 30-year fixed rate mortgage by the end of 2023 is because, well, mortgage rates are too high and it's pulling people away from wanting to buy a home. Now, that's kind of a interesting logic because Well, the reason why the Fed is having to raise interest rates is because inflation is so high. Now, when we measure inflation, what are we looking at? We're looking at the prices of things. And what is one of the factors that contributed to the high inflation? Well, home prices rising so fast. Why did home prices rise so fast? Well, people wanted to take advantage of the low interest rates. So the low mortgage rates caused people to buy homes, which caused bidding wars for homes, which caused the prices of homes to rise so significantly. So if that low interest rates caused the high inflation, why would the Fed want to cut interest rates and cut mortgage rates to make buying a home more affordable when they're trying to bring inflation down? Because if the Fed were to cut mortgage rates tomorrow, if they fell down to 5%, what's going to happen? You bet that there's going to be a flood of new buyers into the market. If new buyers are flooding into the market, well, then you're going to see more bidding wars. If there's more bidding wars, home prices are going to go back up. If home prices start shooting back up, that means higher inflation. That means the Fed would be shooting themselves in the foot. So you have the Mortgage Bankers Association reassuring their bankers, saying, don't worry about the mortgage market. Don't worry about the slowing demand in the mortgages, because mortgage rates are going to fall by the end of 2023. The justification is that mortgage rates are just too high right now and it's pulling people away from the mortgage market. And so if now the Fed doesn't have the ability or doesn't want to bring interest rates down, what is the other potential way that mortgage rates could come back down? Well, this now goes to understanding what is the federal funds rate versus the mortgage rate. See, the Federal Reserve Bank doesn't set the mortgage rate. The Federal Reserve Bank, while they're the central bank of the United States, they set what's called the federal funds rate. The federal funds rate is the interest rate that banks pay to borrow and lend money to one another. So you could think of it like the wholesale interest rate that banks have to pay, and then banks will jack up the interest rate and then sell it to you at the retail rate. Everybody, every store, every business does the same thing. Walmart will buy watermelons at the wholesale rate, they jack up the price, and then they sell it to you at the retail rate, right? That's their margin. Banks do the same thing. The Federal Reserve Bank sets the federal funds rate. That's the wholesale rate. They jack it up and give it to you at the retail rate. Well, if we look historically at the federal funds rate versus the mortgage rate chart, and you can look here, this is the historical chart from the Federal Reserve Bank website, and we're looking back as far as the data will tell us. There's only been a few times in our entire recorded history where the mortgage rate has fallen below the federal funds rate. And these were extreme circumstances when we had significant recessions and different subsidies by the government where the mortgage rate fell below the federal funds rate. Now, if we go to where we are today, mortgage rates are between 7 and 8% in that range, but the federal funds rate is now past 5%, which means if the Mortgage Bankers Association is claiming that mortgage rates are going to come back down to 5.2%, that would mean that mortgage rates would have to fall below the federal funds rate. Now, how would mortgage rates fall back below the federal funds rate? That would mean either A, the Fed has to start cutting interest rates, but like we just said, that could be shooting themselves in the foot by making inflation even worse. Not saying that they're not going to do it, but that's the risk that the Federal Reserve Bank would take by cutting interest rates. Or B, we got to go back to one of these rare and extreme circumstances where now mortgage rates fall below the federal funds rate and banks are essentially lending money for less than what they're paying to borrow it from. So this is where now understanding that sometimes people want to live in, their own la-la land where they're hoping for something because that feels good when the objective reality shows the chances of that are much less. Now, why do they do this? Because naturally you want to keep sentiment high for your bankers. You want to keep the sentiment high for your lenders because that's what keeps people driven and motivated. But this is where now I want you to be objective and understand what's going on. Now, I'm not saying this from the perspective of a banker. I'm saying this now from a perspective of you needing to earn more money. Why do you need to make sure you're working to earn more money? Because of everything that I just talked about. The new economy that we're in right now shows that this divide between the cost of living and wages has really forked in the last few years. And this fork is just going to keep going more and more extreme. Maybe it'll slow down in how much this widening is happening, but the widening between wages and cost of living is going to continue going down this direction, which is why you have to learn how to earn more money, because it's not just about being able to fund your car and pay for your home and pay for your groceries and get that vacation, but you also have to be able to invest your money and save some money, because that is how you will be able to build wealth. And if all your money is going to pay for your mortgage and to pay for your rent and your groceries, you are never going to have a chance to ever be able to become wealthy. And that's the situation that the majority of Americans are in right now, is most people are working just to drive a faster car and have a bigger home. You need to, one, spend less. That way, no matter how much money you're making, you're still putting some money aside to build your own wealth through your investments and your savings. But then, as you do that, you want to make sure that you can accelerate your path to wealth and that you can live the life that you want financially. And that means you're going to have to work to earn more money. Now, again, how can you do that? You can do it from your own job. You can do it from getting a second job. You can do it from creating your own income. You can do it from starting your own business. You can do it from becoming a freelancer or a contractor. There's an infinite number of ways to do this. It has become more accessible than ever. Yes, it is hard work. Yes, it means more work. But the reality is, look at where the economy is. Look at where we're going to be going over the next number of decades, and put yourself in a position right now. That way you can take care of yourself, your family, and your community. Because if you don't start preparing now, you're going to be in for a rude awakening as things continue to progress slowly. And then one day you realize, oh man, life is really getting to me financially, and I want to make sure that I can take care of myself. So start preparing proactively by understanding what's happening. And then the third thing that you got to do is you got to make sure you're investing like crazy. Look, the way that you build wealth is not by saving a lot of money. The way that you build wealth is not by earning a big salary. The way that you build wealth is by investing your money. And I know most of the time, people think that the way you build wealth is by saving or earning a big salary. That's what I thought. I didn't grow up learning about money. No one taught me financial education. I didn't know what investing was. No one told me what real estate investing was. I didn't even know that you could invest in real estate. I didn't know any real estate investors growing up. But this is where now, understanding that wealth is built through investing your money, period. Wealthy people become wealthy because of the assets they own, not because of the salary that they have. Your salary, if that's your only source of income, is one paycheck away from being broke. Because if you're just reliant on your salary, that means that if you can't work anymore, you no longer have an income. If, God forbid, something happened to you and you can't work, or if something happened to you and you never have the ability to work again, or if something happened to your company and the income stops coming in, you still have your expenses. And this is where now you want to make sure you can take care of your family. And the way that you can do that isn't just by working to earn a bigger salary. It's by taking a piece of your salary and using that money now to buy assets. You're working to earn money to buy more assets. The average person is working to earn money to buy a bigger home and a faster car. Wealthy people work to earn money to buy more assets, because your assets can continue working to make you money even when you're not working. Even if you were to die, your assets can still continue to produce an income for your family and whatever causes or charity that you want, but you have to build or buy these assets. And I say build or buy because you can build it by building your own business, where you can buy these assets by slowly working to invest your money. Now, you don't need a ton of money to get started. You can start with as little as $100, even $1 in some instances. But if you slowly start stacking, you will have the ability to earn more money, build more wealth, and have more of that financial freedom. Now, you just got to get started. See, the mistake that so many people make when it comes to investing is they get into this information overload. How should I start? Should I invest in stocks, index funds, mutual funds, options, ETFs? Should I invest in real estate? Should I invest in syndicate deals? When the reality is, the thing that you need to do is just get started. You can always change. You're not setting yourself in stone. And yeah, you will probably lose money at some point. You have to understand that before you go in. But once you get started, that's when you're going to start learning, because now you got actual skin in the game. Once you got skin in the game, you're going to be much more worried about what's going on with your money. And that's what will force you to learn. So get started. Even with $100, start investing. That way you can learn and It's a lot easier to lose money when you have less money in there, and because that pain isn't as painful, but it's still painful even when you see a little bit of money down. But that's how you learn. You got to get involved because that's what's going to help you actually build wealth. I'm not allowed to give investment advice, but if there's one investment that I would recommend that I know can give you a better return than today's housing market, than today's stock market, and even a better return than today's cryptocurrency market, is canceling your Netflix subscription. Stick with me for 1 minute, I'll show you what I mean. The Bureau of Labor Statistics released an American time use summary, and what they found was that the average American spends 2.9 hours a day watching TV. And the way that people watch TV today is, of course, Netflix. And the number one reason why most Americans feel like they cannot make more money or they cannot make a big financial change in their life is because they don't have enough free time. They say it takes 10,000 hours to become a master at anything. Well, if you spend 50 hours doing one thing, I can guarantee you're going to become pretty good at that one thing. And if you spend 500 hours learning and experimenting and trying one thing, you're going to become really good at that one thing. Well, if you work 49 weeks a year and you work 5 days a week out of those 49 weeks a year, and instead of spending 2.5 hours watching TV, you spend that 2.5 to 2.9 hours now learning, building, trying new things. That means after 1 year, even including holidays, including weekends, you're going to spend over 700 hours learning and building your own education on how you can work to earn more money. I can guarantee you that if you spend just 1 year, those 700 hours, and that's not including weekends or holidays, if you spend 700 hours in 1 year working and learning to earn more money, I guarantee you that 12 months from now, you are going to have a completely different mindset and skill set towards earning money, and you are going to know a lot of ways to earn more money. And even if you don't increase your income, 12 months from now, you are going to have the tools and the knowledge and the ability to do so. And now you're going to have more ability to now earn more money. That way you can build more wealth. Time is the number one most powerful tool that all of us have access to when it comes to building your wealth. And so now if you compare two people, one person comes home from work every single day, they sit on their couch, they watch Netflix for a couple hours to decompress, they hang out with their family, then they go to sleep. And then you compare person number two, where they come home from work, they spend time with their family, and then they spend a couple hours working on their business. They spend that time learning about how to manage their money. They spend that time learning how to earn more money. In 10 years, who do you think is going to have more earning capability? The person who's spending their free time watching Netflix, or the person who's spending their free time learning to earn more money? Yeah, it takes more work, it takes more hustle, it takes more time, but you have the ability to do so. And if you now can cancel that Netflix subscription, you are going to free up that free time, the most valuable asset that you have access to. That way now you can reallocate that access, not the money. I'm not worried about the $15 a month. I'm talking about this 2 to 3 hours a day that the average person is spending watching Netflix. If you can reallocate that asset, it costs you nothing to do so, but it can completely change the trajectory of your life, your money, and your wealth if you start learning. Because once you start learning, you can also start earning. But you can't do that unless you start learning and you start trying things. And that's not possible unless you have the ability to do so. I have made a lot of different investments in my career. I've invested in real estate. I've invested in stocks. I've invested in startups. I've invested in gold. I've invested in cryptocurrencies. But the one investment that has given me the best return out of all the investments that I made, and I started investing in real estate when prices were at the rock bottom after the 2008 crash. And still, the number one best investment that I have made was the investment in myself. Now, this best investment that I made isn't just the money that I spent now buying books, buying classes, hiring coaches, hiring consultants, but the time that I spent learning as well. I didn't grow up learning about money. I didn't grow up learning about entrepreneurship. I didn't grow up learning about financial education. All of these things were forbidden for me. I grew up in a very strict, traditional Indian household where I had to go out and become a doctor. In fact, I could either become a doctor or I could become a failure. Those were the only two options that I had. And so when I started learning about money, I went out of my way. This is back before YouTube was available. I had to go out and read books. That was the first time I ever read a book cover to cover. I hated reading. The first time I ever read a book cover to cover was a book called Rich Dad, Poor Dad by Robert Kiyosaki. And when I read that book, it opened my mind to a whole new world of money that I had never been exposed to before. Once I read that book, then I started reading Dave Ramsey's books. And then I started reading more books. And then I started learning and I started applying what I was learning. And this is where now being willing to spend that time, not just reading, but also doing, can change the trajectory of your life. And yeah, it can be very hard. When I was going to law school, I didn't want to go to law school. I went there to make my parents happy. I was going to law school, but at the same time, I knew I didn't want to be an attorney. I went through law school. I became a licensed attorney, and I have never worked a day as an attorney. And the reason why is because when I was in law school, my time was spent trying to figure out what the heck I was going to do. So now I'm in law school, I'm working on my business, and that was a lot of time before classes, after classes. I was running a stock company at the time. I also started my YouTube channel around that time. And so then I also started taking acting classes. I started taking a evening acting class to start learning how do I talk in front of a camera, because I had never done anything like that before. And so now I'm spending my time doing all these different things, and I'm also working to invest in real estate. I also got my real estate salesperson's license. I was doing everything that I possibly could to learn, because that was how I learned. I learned by doing. And I knew that this was my opportunity to learn and do something, because I wanted to achieve something different. And so now if you want to be able to earn more money or invest better or get better returns, or build more wealth, you have to invest more in yourself. They say that, when there's a will, there's a way. We've all heard that statement before. But that's such a vague statement. What the heck does that even mean? When I used to go and guest teach in Detroit Public Schools, it's a very rough school district. Smart kids, many times in tough situations. And I would go and guest teach once a week or once a month in these schools. And I would talk to the kids about money and life and leadership. And I would ask questions like, how many of you have a job? These are high school kids. And pretty much everybody would raise their hands saying that they have a job. Then I would ask, how many of you have a bank account? Nobody raised their hand. Not a single person had a bank account. So I would ask, what do you do with the money that you earn? You get this physical paycheck, you go to the local liquor store, you cash the paycheck, the liquor store owner takes 1 to 10% of the check, you buy a bunch of pop and candy on the way out, and now you have a small fraction of your entire paycheck on the way out. But at the same time, what are you prioritizing? Because when these kids wanted the newest pair of Jordans, they would do whatever it took to get those Jordans, whether it was working extra hours, whether it was sacrificing spending money on things at school, whether it was not eating lunch. People would make huge sacrifices to get the newest pair of Jordans because that's what they wanted. So now my mindset is, how do we now reallocate this mindset instead of getting the Jordans to building wealth? And this is where it goes back to the same thing. When you want something, you will find a way to get it, whether it's a pair of shoes, whether it is a Gucci bag, whether it's a car, whether it's a big home, whether it's whatever. If your goal now is to build wealth, if your goal is to invest in a rental property, if your goal is to build a big stock market portfolio, you got to get hyper-focused on that. That means now you got to spend your time learning how to do that. Because when that's something that you want really bad, you are going to figure out whatever it takes to do that. And it becomes much easier to make those sacrifices because nobody likes not being able to go out to eat. Nobody likes not being able to go on a vacation. I mean, these sacrifices suck. How are you going to explain to your wife or your husband, hey, we can't go out to eat anymore because I want to get rich or I want to become wealthy? Win. What does that even mean? Nobody wants to just make sacrifices for the sake of making sacrifices. You got to get on the same page where, hey, let's make this financial sacrifice. Let's not go on a vacation this year. That way we can work to build our wealth. That way in a few years, we can go on 2 vacations a year instead of just 1. Because now you're working for something bigger, and that's what you have to align yourself on and your goals on is how are you going to get bigger? And then you got to get laser focused on that idea of getting bigger. And now the resource that is the most powerful is your time. Of course, you have to use your money smartly. But your time, if you can use your time the right way, that's what's going to show you what you can do with your money That way you can grow your money, and that's what's going to show you how you can earn more money. That way you can have more money to invest. But this means you are going to have to allocate your time. And I know it's not easy. If you got kids, it's not easy. If you got a spouse, it's not easy. We all got things going on in life. Everybody's having babies. Everyone's got a baby shower. Everyone's having these graduation parties. There's always something going on. But you got to get focused on you. I call it a decade of sacrifice. Now, of course, it's easier to do this when you're in your 20s, but it's easier to do it in your 30s than it is your 40s. It's also easier in your 40s and your 50s. And it's also easier in your 50s and your 60s. But this is where the sooner you start, the better it is, because the decade of sacrifice, where now this decade you are working to spend less and earn more. That way you can do one thing, invest your money. That way you can build wealth. That's what's going to allow you to set yourself apart from everybody else that you know. This isn't a 6 steps to building wealth system, because those 6 steps to 6 figures systems are making one person rich, and it's not you. If you really want to build wealth, you are going to have to make sacrifices. There's no other way around it. And that means putting in the work, putting in the time to spend less and earn more. That way you have more money to invest. And if you put in that effort, if you cancel the Netflix, if you cancel some of that time, that way you have more time available to allocate to you building wealth, you will surprise yourself how much you can learn in just 6 months. When you first start learning anything, it is so overwhelming. I go through the same thing even in business. When I go and start learning a new thing, if I started learning about building a good SEO website, it's going to be very overwhelming, because now you start hearing about all these terms and all these ideas and all these strategies and all these different opinions. That is just information overload. But if you stick with it and you start breaking it down and you start digesting and you start watching more videos and you start reading more blogs, eventually, once you put in 50 hours, you're going to start learning the basics. When you put in 500 hours, you're going to know it really well. You're going to know it better than most people out there. And it takes the time and the dedication to be able to do that. Now you can change it from building an SEO website to learning how to build a business, to learning how to earn more money, to learning how to invest your money better, to learning how to invest in real estate, to learning how to invest in real estate without a ton of money, to learning how to invest in stocks. It doesn't matter what it is, but you have to start reallocating your time. If you've been subscribed to my channel, you've probably heard the saying, pay yourself first, that you got to pay yourself first before you go out and make everybody else rich. Because, well, now when you invest your money before you go out and spend your money, now you can make yourself rich first. Well, it's the same thing with your time. Spend your time on you first before you spend your time on everything else. Now, of course, you got to spend time with your family, your spouse. I get that. But I'm talking about the Netflix time, because that's time that's just killing your brain cells. Reallocate that TV time that's not doing anything to now something that's going to be more productive. And if you say, but Jaspreet, that's my time to relax and unwind. Listen, you can unwind a whole lot easier when you're rich. Work to build what it is that you want. And I'm not saying you got to go and kill yourself watching these YouTube videos and learning. You can be relaxed and watching some YouTube videos too. There are some entertaining channels that can teach you how to build wealth, that can teach you how to invest your money, and that can be another form of unwind. And it's just like starting to be healthy. When you go from eating donuts and Twinkies and Ho-Hos every day, and then you start eating a salad, it's going to taste like crap. But once you start eating salads, you're going to realize, oh, you can make a salad taste pretty good. And then you start liking the taste of the healthy food options, and then the unhealthy food starts to taste bad, because now you've changed your palate. You've changed the way that your tongue likes food. It's the same thing with your time. When all you're used to is watching dumb TV shows and movies on Netflix, where as soon as you start watching something educational, it's going to feel so boring and so annoying and so stressful. But as you start to watch more of the educational content, now all of a sudden you're going to start liking it. You're going to like the feeling of learning and becoming smarter and having education that can allow you to increase your income. And then you're going to realize, wait, wasting my time watching all of these dumb shows isn't as fun or as enjoyable as I thought. But it takes that initial ditching the donuts and the Ho-Hos and start eating the salads. It's the same thing here. You're ditching all the brain-killing content. That way you can increase your wealth content. And the reason why this is so important now is because of the current state of the economy and how our money is changing. Now, of course, what I always like to say is your mindset is the precursor for any success. The way you think is going to change what you do, and what you do is going to change what you get. And the way that you can change what you think is to change how you spend your time. You got to change the environment that your brain is in. When your brain is in a toxic, negative, brain-killing environment, whether that's around toxic people, whether it's around drugs and alcohol, whether it's around a bunch of broke people with negative attitudes, you're going to be absorbing all this negativity and all this bad stuff that's going to make it very hard for you to think positive, successful things. That's going to make it extremely difficult for you to do anything that's going to bring you any positivity and success. And so if you don't have that environment around you, you got to put yourself and force yourself in that content. And the most accessible way to do that is just to reallocate that free time that you have to something that's going to allow you to learn. That way you can start changing the way that your brain is wired and start changing the way that your brain thinks. That way now you can start thinking of ways to grow your income and build your wealth instead of just thinking of ways of how can you just shut off. Now, we are entering a strange economy, and we're already in a strange economy, but that's what then accelerates the importance of this because, well, our economy is going through its own struggles right now. The Federal Reserve Bank has set a goal to bring inflation down to 2%. But what they've been realizing, especially in 2023, is that bringing inflation down all the way to 2% is much harder than what they originally thought. The way that the Federal Reserve Bank is working to bring inflation down to 2% is by, number one, raising interest rates, and then number two, by doing what they call quantitative tightening. Quantitative tightening is essentially getting some money off of their balance sheet, aka removing some of the money in our economic system. Well, what they're saying now is that this fight to bring inflation down is going to cause more economic pain than what they originally thought. Now, the reason why this is so interesting for you to understand and so important for you to understand is just the general trend of the Federal Reserve Bank's opinions about our economy and how things will progress. Because if you remember, when we first started seeing the quantitative easing and the money printing, everyone said, including the Federal Reserve Bank, our central bank, that none of this quantitative easing is going to cause any inflation. And then, of course, we saw some inflation that they said, well, it's nothing for you to worry about because this inflation is transitory. Well, not too long after that, the Federal Reserve Bank came out and said, okay, this inflation is not transitory, but we have it under control. Then the Federal Reserve Bank said, okay, you know what? We're going to have to raise interest rates to bring down inflation, but we don't have to worry about raising interest rates right now. We will start raising interest rates in the future. And then the Federal Reserve Bank said, okay, we're going to start raising interest rates right now, but we don't need to be that aggressive with raising interest rates. We can just raise interest rates by 0.25%. And then, not too long after that, the Federal Reserve Bank said that, okay, bringing inflation down is a lot harder than we thought. We need to increase significantly interest rates. That way we can cool down inflation. Now what we're seeing happen is the Federal Reserve Bank is saying, yeah, we still need to stay tough on this fight on inflation, and it might actually bring some economic pain. This is the first time now that the Federal Reserve Bank is saying that we could see some economic pain because of this fight on inflation, because up until, well, the early middle part of 2023, the Federal Reserve Bank kept saying that, one, inflation is not a problem, and then bringing inflation down would not cause any sort of economic pain. So now the question is, how much economic pain are we going to see? Because remember, in the beginning, the Fed said that we're not going to see any inflation. Then they said inflation was transitory. So the question is, are we really going to see a mild recession like the Federal Reserve Bank says? Are we going to see no recession, or are we going to see a more significant recession that maybe the Federal Reserve Bank doesn't anticipate just yet? And the way that you can start to understand this is just to think, what is it going to take to bring inflation down to 2%? Now, everything that I say is going to run on that premise. It's assuming that the Federal Reserve Bank is going to stick with their word of wanting to bring inflation down to 2%, because there's always a chance that the Federal Reserve Bank can pivot. And by pivot, I mean that they say, you know what? Inflation hasn't come down to 2% yet, but the economy, unemployment, jobs are becoming a bigger concern. So instead of working to bring inflation down, we, the Fed, are going to pivot and we're going to cut interest rates. That way we can stimulate and boost the economy, or we're going to print money that we can stimulate and boost the economy. The Fed could do that. If the Fed makes that sort of pivot, well, that could boost the economy in the short term, but then that would also make the inflation problem worse. And if that happens, that's going to completely change the trajectory of our economy, our currency, and really everything to do with building wealth because, well, inflation is a real problem. And inflation disproportionately hurts people who are financially uneducated. It disproportionately hurts the poor. It disproportionately hurts the middle class. And it disproportionately benefits the wealthy and the investors, which is where you would see a bigger divide between the haves and the have-nots. So everything that I say from now on is going to be on the premise that the Fed is going to stick true with their word, with their promise of wanting to bring inflation down to 2%. That's what they have been saying for years now. So if the Fed wants to bring inflation down to 2%, what are their tools to do that? Well, the Federal Reserve Bank doesn't have fairy dust to bring inflation down. And in order to bring inflation down, they have to cool down demand. So now, to understand what that means, you got to understand what is inflation. Inflation comes from the word inflate. What are you inflating when you have inflation? We are inflating the monetary supply. We're inflating how much money is out there. So now, when there's more money out there, more people have the ability to spend. And when people have the ability to spend more money, that means more and more people are going to want to go out and buy a home. So now, if more and more people want to go out and buy a home, you're going to see more bidding wars. If there are more bidding wars on homes, well, that pushes home prices higher. This is what we've been seeing happen. When you have these bidding wars and home prices go higher, that then goes on the inflation report saying home prices have gone up so significantly, and then that also pushes up inflation, the inflation numbers that we see. So now when you see this higher inflation numbers, that's when the Federal Reserve Bank says, okay, we need to now raise interest rates to bring inflation down. That way we can cool down demand. So now when interest rates go up, mortgage rates go up, now people, before they go out to make an offer on a home, they think twice. You know what? I don't want to pay these higher mortgage rates to buy a home. Maybe we'll rent a little bit longer. Or maybe we won't move out right now. We're just going to stay here for a little bit. That way now, instead of having 40 offers to buy a home, maybe you have 10 offers or 2 offers or no offers on your home. And now what happens? Well, if there's less demand of people wanting to buy a home, you see less upwards movement in home prices, which means now if there's less upward movement in home prices, the inflation report says that home prices haven't grown as much, so you see a lower CPI number, a lower inflation number, which then signals to the Federal Reserve Bank that the higher interest rates are working. Well, what we've been seeing happen up until now is that the Federal Reserve Bank has clearly worked to increase interest rates significantly. I mean, over the last 18 months or so, interest rates have gone from essentially 0 to 5 and some change %. So interest rates have gone up very quickly. And that also means that the cost of borrowing money has gone up very quickly. And because it's happened so fast, we have yet to really see the full impact of the higher interest rates. Some economists and studies say that it takes 12 to 18 months for an interest rate hike's impact to be felt. We started raising interest rates approximately 18 months ago, which means we're really starting to see the impacts of the early interest rate hikes now, but we haven't seen the impact of the later interest rate hikes yet. That has yet to come. Now, what is the impact of lower demand and higher interest rates? Well, it goes back to understanding how does our economic system work? Our economic system runs on spending. We've done a ton of deep dives of this on Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. Yes, I am very biased because I created Market Briefs, but I also read Market Briefs every morning, and it's an easy way for you to stay up to date on what's happening with things like our economy, inflation, the housing market, the stock market, even crypto and the global economy. That way you're not blindsided about what's happening in the economy. We keep it unbiased. That way you can avoid all the sensationalism, and it's a really fun read. So if you haven't joined Market Briefs yet, it's completely free. And I got the link to how you can join my newsletter for free down in the description below. But our economic system runs on spending, which means the more money you make, the more money somebody else makes. When you make $100 and you go out and you spend all this money at Sweetgreens or Lululemon or Apple, these companies then make money. And when they make money, they have the ability to pay somebody's salary, and they have the ability to open a new store, and they have the ability to invest in new products. If you don't spend your money at these places, they don't have the ability to make payroll. They don't have the ability to hire more employees. And so when our economy runs on spending like this, the more money people spend, the more money businesses make, the more jobs that there are, and the more the economy grows. Well, what has happened over the last number of years, was so much money was created. I read on NASDAQ's website just the other day that the total money printing between 2020 and 2021 was right around $13 trillion. That includes the COVID stimulus, that includes things like the infrastructure programs, and that includes all the other quantitative easing by the Federal Reserve Bank. That was about $13 trillion of money printing that happened, of new money creation that entered our economic system. That was the most amount of money we have seen enter our economic system in such a short period of time ever. It made the money printing after 2008 look like a drop in the bucket. Back in the 2008 crash, when we were talking about almost $1 trillion stimulus plan, people were losing their minds because of how significant $1 trillion of quantitative easing and stimulus would be. Now we're talking about multi-trillion dollars worth of economic stimulus. So just to kind of put it in perspective, it was a huge amount of money that was printed in 2020, 2021. So now all this money was created and it entered our economy. Now it went into people's hands in the form of stimulus checks and unemployment checks and some loans, which people spent at businesses, and then also went into the hands of businesses and corporations. Now again, businesses and corporations are also consumers. They spend money too. And so now when you have all this money out there, naturally, you're going to see a boost in the economy. We saw the economy boom in 2020 and 2021, even though we were coming out of the worst recession since supposedly the Great Depression. But no one really felt any sort of economic pain. So now all this money came into the economic system. The economy boomed. Businesses had so much money that they were expanding like crazy. We saw new offices being built, new virtual offices being built, new employees being hired, raises being given, bonuses being given, new departments being created, and people going out and spending money. Now, of course, the prices of things were rising, but it never really bothered people because people had more money, whether it was stimulus checks, unemployment checks, raises, or new jobs, or whatever it might be. It didn't really affect people. Now, of course, some people were, but on the general level, people still had the ability to spend more. And then in 2022, the party started to stop because in 2022, that was when we started to see the money printing go away and we started to see interest rates start to rise. The first interest rate hike started in 2022. And that was when we started to see that change. Now, it wasn't a very drastic change in the beginning, but that was when we started to see that change, where now the Federal Reserve Bank said we need to cool down demand. Now we are here in 2023, and the Federal Reserve Bank is very serious on trying to cool down this demand, which means they want demand for items to cool down, that way we can cool down inflation. Now let's think about what that means. If you reduce the demand for people to buy a home, that means you're going to have less people out there wanting to buy a home. Now, if you go from 40 offers to buy a home to 2 offers, that means you might not be able to sell your home for above asking like you might have thought. Maybe you might even have to eventually cut the listing price if you don't get enough offers in the first 30 days. And so if we see demand fall for items, now obviously that could impact the housing market in certain ways, but that would impact many different businesses. Because just think about it this way. If Chipotle is not seeing people go into its stores anymore, because the demand for Chipotle has gone down, what does that mean? That means they might not open another store, which means they might not hire more store people because, well, they're not opening more stores. Maybe that means they need to get rid of some of their research people because they're not going to be creating new products and new lines of things yet because they don't have the revenue to do so. And when you start to see that across the broader economy, that's going to have bigger impacts because if businesses see less demand, they're going to have to do something to manage the profit margins because businesses want to maintain a certain level of profit. And so now if demand falls, that means revenues fall. So if businesses see the revenues fall, they're going to have to do something because if revenues fall but their costs staying the same, that means their profits shrink. But that's not what we're seeing happen. We're not seeing revenues fall with profits or with operating costs staying the same. We're seeing operating costs rising. Now, of course, inflation impacts everybody, including businesses, which means businesses have to pay more money to get their things and to pay for the labor, which means if demand's falling, revenue's falling, while costs are also rising. Not to mention the fact that in 2020 and 2021, we saw the largest boom in corporate debt ever. Corporations used the 2020 and 2021 low interest rates to load up on debt. And why wouldn't you? These were the lowest interest rates that we saw ever. And so corporations said, how about we use this as an opportunity to go out and borrow more money? Many corporations did that. Now, some corporations used this more money to invest in their business, to use this debt to go and create more income. That's what you would want to do with debt, right? It's like going out, borrowing money to buy a rental property. That's what most people would consider good debt. But then some corporations also did the opposite. They did what many might call bad debt. They went out and they borrowed money to make their shareholders richer. Think of it like going to the Gucci store, not having the money to buy a $3,000 handbag or wallet or whatever it might be. And then instead of saying, you know what, I can't afford it, you just put it on your 0% APR credit card because the interest rates are so low. Well, many corporations did something similar. They use it as an opportunity to load up on cheap debt and then use this money to do a stock buyback or a one-time special dividend, meaning corporations took out huge sums of money at low interest rates and then used this money to give it away to their owners, their shareholders, to make the shareholders richer, which is great in the short term. You feel like you're rich, you got the Gucci handbag or you got the money in your pocket, your stock price went up. But you're going into debt to fund something that is not income producing. See, if a business is going into debt to open up a new store or to open up a new manufacturing plant, that's an income producing asset. You're going into debt to produce more income. But when you go into debt to do a stock buyback, which raises the stock price, or you go into debt to pay out a dividend, that's not an income producing asset. That's going into debt to make your shareholders richer. And in 2020 and 2021, we saw a record amount of levered corporate buybacks. Levered corporate buybacks are when corporations use leverage, aka debt, to buy back their own stock. Now, okay, that's the first part of that. The second part of that is that corporations don't have 30-year fixed rate mortgages. What do they have? Adjustable rate mortgages. And most corporate debt is readjusting every 3 to 5 years, which means that in the next 24 months, we're going to see a huge chunk of corporate debt readjust. Well, now let's think about that for a second, because a few years ago, interest rates were the lowest rates ever. That's when corporations started taking out these huge sums of money. In the next 24 months, when interest rates readjust, if interest rates are higher, that means the payments on these debts will also increase. So now, let's go back to the diagram. Demand is falling. That's what the Federal Reserve Bank is working for, which means revenues are falling, unless corporations can find a way to increase revenue, but it's a little bit tougher when you're seeing a slowing economy. So revenues are struggling to rise or they're starting to fall. Costs are rising because, well, inflation, higher labor costs, higher product costs, but then you also have the higher debt costs because corporations don't have 30-year fixed rate mortgages, so debt servicing costs start to rise as well. This then puts a lot of businesses in a tough predicament, which is, okay, our costs are rising, our revenues are falling, we're going to have to make a change. That change is either we got to increase our revenue or we got to cut our costs. Again, like I just said, it's kind of difficult to increase your revenue when people have less money to spend. And people have less money to spend because inflation is so high. People have less money to spend because, well, people are seeing kind of the economy slow down. Eventually, if that continues, you're going to see less job opportunities. So people have less money to spend because of that. But then you also have, how do you cut your costs? And that's where one of the most accessible ways to do that is by letting some people go. Now, obviously, we've been seeing this happen in the tech sector and some other sectors now. And this is where now the question is, how much further will that go? Because it ultimately comes down to inflation. If the Federal Reserve Bank wants to bring inflation down to 2%, they're going to have to do more work in order to do so. What is that work? Raising interest rates. Well, what does raising interest rates do? It cools down demand even more. Cooling down demand even more slows down the economy even more. It slows down revenues even more. And this is that situation that we are just starting to scratch the surface of this happening. And it doesn't look like it's going to be going away anytime soon because inflation still has a way to go. And we still have to feel the impact of the higher interest rates. And now businesses are starting to see the impacts of, one, the higher costs and the debt servicing costs starting to rise. And this is something that over the next 24 months, we're going to see more and more of this progress. And while most people want to assume that everything is just going to be just fine, you have to pay attention to the red flags, because the reality is this could create a lot of opportunities. It could also hurt people financially if you're not financially prepared. Now, you can look at what the Federal Reserve Bank is saying. The Federal Reserve Bank says that their prediction is that inflation is going to come down to 2% by 2025. Well, what does that mean for inflation to come down to 2% by 2025? That means between now and 2025, we're going to see above 2% inflation. Well, that also has its consequences, because like what I've been talking about, what does inflation do? Inflation hurts your buying power. And so if we continue to see higher than 2% inflation, that means more and more people are going to have less ability to spend. That also causes economic pain. So now if you kind of paint the picture of a triangle, we have three different things happening at the same time. We have the high inflation, which is slowing down the economy, because high inflation hurts people's ability to spend. When you have high inflation, that means your rent is more expensive, your groceries are more expensive, so you have less money to spend on discretionary items. That means these other businesses have less money coming in because people don't have the ability to buy their products. Then on the second corner of the triangle, you have the higher interest rates. Higher interest rates are also hurting the economy because, well, the higher interest rates are cooling down demand. Higher interest rates makes borrowing money more expensive, which hurts people's ability to spend, right? In our economic system, you can spend money with the money you work to earn, and you can also spend money with credit. That's how money works in our economic system, because people don't just spend money based off of how much cash they have in their bank account. They spend based off of how much debt or credit they can qualify for. As interest rates go up, the amount of credit that's available goes down because less people are likely to borrow money, which means less spending is happening, which also cools down the economy. And then the third thing that we have happening, so we have the high inflation, the higher interest rates, is the slowing economy. And that's something that we're seeing happen right now. And this is where everybody has their question mark and their fingers looking right now is the economy going to slow even further? Now, of course, everybody has their own opinions, and people don't want to create any panic or fear, but you have to understand this is what's happening. The high inflation is slowing down the economy, the higher interest rates are slowing down the economy, and we're just starting to see the impacts of all these things, and the economy is just starting to slow. Now, some people are saying that this is going to be contained to tech, but I don't want you to be blindsided by what's happening, because your job as a financially educated person is to be prepared for the worst. And prepared for the worst means when you have economic pain, being prepared to capitalize on opportunities. The reality, I'm going to be very honest with you. The reality is when you see economic pain, that also creates the opportunity to see the most economic gain. And the people that can get the most economic gain out of the economic pain are the people that are prepared and the people that are financially educated, which means you need to be financially prepared and educated. That means number one, you need to have cash put aside to be able to capitalize on opportunities. You can see the greatest investment opportunity in front of you, but if you don't have the money to take advantage of it, it doesn't do you any good. That means, again, spending less, earning more to have the ability to capitalize on opportunities. And number two, working to build that financial education, spending your time to learn, to build that financial education, because when you have these two things together and then you see an opportunity, you have the ability to capitalize on the opportunity. Now, the reality is somebody will capitalize on these opportunities. That has always happened every time we see an economic slowdown. There's a reason why market crashes and recessions create more millionaires than any other time. It's because some people are prepared for it and they're able to capitalize on the opportunities when they happen. Now the question is that going to be you? And you have to make the decision for yourself. You can hate it, you can complain about it, but this is the reality of the game. Now, financial education is obviously so important, and that's why I'm working here to help people learn about what's going on. That way you can finally capitalize on opportunities, but the reality is booms and busts are a part of our economic system. They have happened and they will continue to happen. We've seen a recession pretty much every decade for the last century. And to think that we're not going to see some sort of recession at some point in the future is just, it doesn't make any sense. It's based on no logic whatsoever. Now, nobody knows when it's going to happen, and I think that's the misconception is everyone's trying to time it. No one knows when it's going to happen. It will eventually happen, But this is where you want to be prepared and pay attention to all the things that are happening, because unlike previous recessions, we have some different situations now, such as the higher inflation, because prior to pretty much every other recession in modern history, the Federal Reserve Bank used to be able to create inflation to pull us out of the recession, right? When you see the economic slowdown, the Fed would just cut interest rates or print money and inject it into the economy to stimulate the economy. And you didn't have to worry about inflation because, well, inflation wasn't a problem then. But today, inflation is already a problem. And now we're starting to see the economy slow down. So the Federal Reserve Bank doesn't have the same ability to inflate the way that they did before. Can they? Absolutely. The Fed can cut interest rates and print money and throw it into the economy, but the consequences of that are much more apparent now because the inflation genie has already come out. And so this is where you have to be cautious and understand this and understand the risk factors, because this can also create the most opportunities. The most potential economic pain can also create the most potential economic opportunities. And I know this makes a lot of people upset when I say this, but this is the reality. I mean, you can be mad at gravity for existing, but the best thing for you to do is understand gravity and learn how to use it to your advantage. This is what's happening in our economic system. You can hate me for telling you, or you can understand it. That way you can use it to your advantage, because I want you to be able to build wealth. That way you can take care of yourself, your family, and your community. It is your duty to become financially educated. That way you can bring that wealth for yourself and your family. Because it's you who's got to pay for your bills. It's you who's got to pay for your kids' college, or it's you who's got to pay for building that financial foundation for your family. And so if you want to be able to do that, you have to get financially educated and get prepared. And that means understanding what's going on. That way you can capitalize on whatever the opportunities will be your way. Now, of course, I'm working to keep you updated here. If you haven't joined Market Briefs yet, do so. Briefs.co/market. It's an easy way to stay up to date. But this is where you need to make sure that you're working to, number 1, spend less. Number 2, earn more. And then number 3, invest like crazy. I knew I wanted to be rich when I was a kid. Not because I was some greedy, money-hungry child, but because I just wanted to buy my dad's time back. My parents are immigrants from a state in India called Punjab. And the way it works is when your parents come from a different country, a poorer country, and then to come to a place like America, now not only